Hello there, this is Michael Blanc from themichaelblanc.com. In this video, I want to talk about investor returns. So that really drives the entire deal. So yes, there's cash and cash return and cap rate and all those other metrics, but they really have to back into what is the overall return for the investor. And the returns are composed, of course, of the annual cash flow, which is measured by the cash on cash return. It's measured by the amount of how you pay down the loan, and also if there's any appreciation on resale down the road. All that makes up the overall average annual return for the investor, and that really drives my deal. So what I want to do in this video is show you how I use my Syndicated Deal Analyzer to analyze the deal from the investor's point of view. So let's get started. All right, here we are with our 44 unit. That's a good looking building. All right. So we're going to bring up our Syndicated Deal Analyzer, and we're going to enter in, as we did before, the income and the expenses. And we're going to assume the 10% vacancy as well as 50% of expenses based on the income reported. All right. So in our first investment criteria, as we said, we want to buy this at a 10 cap. In order to buy this on a 10 cap, which has a net operating income of $221,000, times 10 would have to be an acquisition price of $2.2 million. That gives us a 10 cap. All right, so this is one of the investment criteria. For me, the overarching investment criteria is always the returns for my investors, and I want to know what the returns are for me as a syndicator also. Let's take a look at that real quick. So what I've done here is I've given my investors 75% of the building with me retaining 25%. And I want to know what are the returns for those investors. So I can see that based on that income in year one, I'm going to have an 8% cash and cash return. And over the life of the investment, they're going to have a 20 plus return here. Okay, so that's a pretty good return. It might be a little higher than it needs to be possibly. All right. Now, if you go up here, you can see the purchase price. The analyzer estimates the closing costs for you here, which you can access in the acquisitions tab. It kind of breaks it down. It has some rules of thumbs in there, which you can override also. And then we estimated about $5,000 a unit here, which is $220,000. So basically, we have to come up with $1 million cash to purchase this building with 30% down, those repairs, and those closing costs. All right. So, to me, the overarching requirement is to give the investors between 11 and 15%. So the fact that we have a 20% return here is pretty good. Maybe I don't have to give them quite that level of return. Maybe I can give them 65%. Okay, so I can start playing with different ways to structure this deal. Let's say I decide to give them 65% and we retain 35%. We'll go into the returns 5 years, and we can see kind of what their returns, how it breaks down. So we have the member cash flow here each year. This is the cash that we're distributing from this deal. And then in year 5, the members, in addition to getting their money back, make a profit of $490,000. And if you look at that, it comes from the sale tab. All right, assumes the cap rate that we're selling at. And then it returns the member capital. You can see here the principal that was reduced over those 5 years quite a bit, and 65% of the appreciation is paid to the members. So you can see all that here. Now, for us as a syndicator, we want to see if we go through all this trouble, what are we getting paid? So as 35% owner of this, our cash flow a year is between 36 and 45 in year 5, and we get a big nice check of $263,000 at closing, which means that our overall return of this is $673,000 in 5 years. Not a bad deal. All we had to do was find a deal and raise $1 million to get that. So this tab shows you what that looks like, and this is the 10-year tab, which shows you the same thing. So in other words, the lesson here is in the summary tab is that really this to me is the driving number here. So the cash and cash return is also important because the investors do want to see some amount of cash. But as an investor, the overall thing is, what is my money going to do each and every year. And so as I go through the analyzer and I tweak the purchase price and the repairs and other things, I always go back and look at that average annual return to make sure it's somewhere between 11, 15, maybe a little higher depending on the deal. So anyway, so that's how we pay attention to the investment criteria that we have, which for me bubbles down to the actual average annual return.